Participants are requested to provide their name and company when prompted by the operator. Participants not providing these details may be disconnected from the call. I now hand the conference over to Mr. Prakhar Sharma, Research Analyst, Jefferies, India. Thank you, and over to you, sir.
Thank you. Good morning, good evening to everyone, and thank you for being on the call. I am Prakhar. I lead the financial sector coverage at Jefferies in India. I also have Rahul on the line from US.
Hello, everyone. This is Rahul Ajmera. I work along with Prakhar as a salesperson covering our clients out of US and Canada. I wanted to extend a very warm welcome to all of you. And thanks a lot, Mr. Jagdishan, Mr. Srini, and Mr. Shetty, for the privilege to host you today. It's pretty late in the evening for you in India, yet you've been very kind to give us this opportunity. So thank you so much for that. Also, my thanks to all the investors on this call who are participating from multiple geographies today. We sincerely appreciate it.
Thanks, Rahul. Everyone, we have the immense pleasure of hosting Mr. Sashi Jagdishan. He's the CEO designate and has been the change agent at the bank. We also have Mr. Srinivasan Vaidyanathan, the Chief Financial Officer at the bank, and Mr. Ajit Shetty, Head of Investor Relations at the bank. Thank you, gentlemen, for sparing time to be on this call so late in India. And I'm really looking forward to conversing with you. Before I start off this call, I'll request the operator to just initiate on the Q&A assembly line. And before we get on to that, we will, I'll start off with a few questions. So, operator, please go ahead.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may please press star and 1 on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question.
Yeah, thank you. So, Shashi, welcome to the call. And we were hoping to keep this call as a conversational call. And, let me start off this one by asking you that you've worked with Mr. Puri for over 2 decades and almost from the inception of the bank, and you've also been involved as a change agent. Can you share with us what changes have you been bringing about over the last 1.5 years, and what would be your immediate priorities as you take charge, especially in a post-COVID environment?
Sure. Thank you, Prakhar. Thank you to all the investors for joining in from their different geographies. Good morning to people from US. Good afternoon for people from Europe. Good evening from India and from other parts of the Asia Pac. Your question is pretty much, as I said, is something that I've said it before. I could have asked anything better than what I have got. The privilege of being mentored over 25 years by Mr. Puri. So obviously the delivery styles would be different, but I've imbibed the best out of him over the 25 years. So I think I will always consider that as the best gift that any professional can get in his life. Over the last 1.5 years, I did not realize when suddenly he probably had different thought processes and plans, and he said that, look, this is going to be a very interesting and a very important part of our journey as an institution. It is imperative that you start to be my eyes and ears. You have been for a long time as a CFO, but you need to shrug off that particular role and move into a more strategic role. And which is why I think I was given the call that you need to ensure that you have adequate, reasonable amount of succession planning in your area of influence. and that is how we got in Srini as the CFO of the bank, which probably the organization is blessed to have a wonderful person with such rich experience of 27 years in global markets in multiple areas of the banking sphere. I think you will see the kind of value and the culture, the ethos, and the integrity that he brings onto the table. Where I think, in the shortest possible time, he is sort of adapted well into and got into the groove of this particular work that he's doing. I don't think I would have, got into that groove as fast as he has. Number two is, when Mr. Puri announced me that you need to become the strategic change agent, it took me a lot of time to understand the import of that particular change. I had to shrug my role as a bean counter and go down, roll up my sleeves, and go down to the brass tacks to understand whether what we are thinking about strategy, is it getting implemented at the ground level, what are the roadblocks, what's working, what's not working. So this has been a huge eye-opener. Normally when sitting in the central office and trying to have reviews, even you may have reviews sitting centrally and trying to have with the heads. But unless and until you go down to the belly button, down in the boondocks of the country, because that's where we are extensively spread in the entire part of the country. And you will try to understand and hear and listen to multiple facets of what's peculiar to that particular geography, to their zone of influence, to the neighborhoods, to the culture there. So we realize that there is no one fit all in terms of when you're trying to implement a strategy. You need to ensure that you tweak it constantly. You have the ability to sort of, listening from the ground level and trying to see whether what you're thinking about is actually what's happening at the ground level. Now, this is one of the most important learnings of my life. And as I said, only a man with that kind of a vision can sort of make this kind of a disruption in someone's professional career to be able to, push him into that. And he pushed me into that. It's only after I got into that I realized how important it was for my own professional journey. So this is the biggest learning, and I think that has brought me, completed my entire 25 years journey to a wonderful conclusion in terms of how do you navigate complexities, how do you navigate a large organization, how do you, when you think about a strategy, when you agreed upon a strategy collectively, how do you make it work? So that was the biggest takeaway from in the last 2 years, ever since I became a strategic change agent. This is going to keep me in good stead when I take over in October.
Great, thanks, Shashi. Now when you look at next 5 or 10 years of HDFC Bank, what are the shapes and forms that you see, or what's the transformation that you see for the bank, either in terms of being a retail or a corporate lending, urban or a rural profile? You've done enough unsecured. You think can that continue? So I'm just kind of keeping the landscape open, just trying to touch upon a few things like fees and lending income, organic and inorganic opportunities. How do you look at the next 5 to 10 years for the bank?
I think we are all blessed to be in a country like India. India is, and especially for financial services, it is still underserved and underpenetrated to a very large extent. 70% of the banking system is still with the PSU bank. Even if you were to take the top 5 banks, the public sector banks, to either retain or grow their market share. There is still a huge amount of balanced market share which is available for grabs. We don't want the entire balanced market share. All we need is the top 20-25% of that particular segment, which meets our customer segmentation. And that could be another 7 to 8%. After 25 years, we are now 8% on the deposits in terms of market share, 9% in terms of the loans market share. So, we have, at a 7 and 8% target market share, there is a huge runway for us to grow. So we don't have to do anything stupid at all. All that we need to do is to be focused, address the target customer segment, don't dilute your credit standards, continue with the same kind of segmentation and risk standards, and you can, as long as your execution skills and your focus is intact, I think we should be able to nibble away the share the way we have been nibbling away over the 25 years, if not faster. So, the fact that we are in this kind of a country where the per capita income, both in urban and semi-urban parts of the country, is moving up and way below what is there in developed countries, and the fact that India is now having its vision, which probably is, moving towards the 5 trillion in the next 3 to 5 years, and beyond that after some time, the opportunity for consumer durables and financial services is going to really take off on a geometric progression. Now, that is where we have a great opportunity, because if you look at our past history, we have been expanding our distribution footprint by opening a lot more branches. We continue to do so. We are expanding our footprint in the semi-urban and rural parts of the country, where 50% of our distribution is now there, and we want to continue to ramp up that distribution. We plan to partner with a lot of other partners like business correspondents who come in various forms and shapes. We've already tied up with the Government of India's Common Service Center, which is going to be one of the growth engines for us going forward. And we are trying to have partnerships with multiple such enterprises who have a lot of distribution. So it's a combination of what we can do ourselves and what we can collaborate with a lot of other partners on the offline mode. Even in the rural and semi-urban, with the fact that we've now realized over the last 15, 20 years, the amount of social spending that's been happening from the government, which now is an imperative for any government to continue spending, if at all you need the votes. The fact that we are well positioned there and we have a proven track record and experience in that geography, I think we are well positioned to capture large addressable segment that's going to come about over the next 5-10 years in that particular geography. So we are well positioned there. We have a track record. We have seen multiple business cycles both in the country. We know how to manage that. We have our actual loss experience has been well within what we have seen as expected loss. So I think the platform that we have is quite exciting. I think time has come wherein, with strategies implemented, with experiments being successful, I think over the next 3 to 5 years, we should press the pedal to sort of gain scale and probably nibble away the share that I was talking about much faster than we have done over the 25 years. This is where Mr. Puri keeps saying that the best of the bank is yet to come. So he has a lot of hopes. He thinks that, with the kind of great management team that he is leaving behind, all of them, imbibed or have imbibed a lot of learnings from him over a long period of time, not just horizontally, but even from a depth perspective. A lot of people, we have also brought in a breath of fresh air in the management team so that you have a balance between continuity and a breath of fresh air and new insights coming in. And some of you probably would have seen a fair amount of new faces with a lot of hunger and the fire in their bellies. So the opportunity is very exciting. All I need to do is to scale up the 5 key strategies that we've been talking about, which I can, probably after this particular thing we can count, and then prioritize them in terms of what is most important in the order of which will give us a lot of scale. So let me pause out here, and probably maybe in the next question I can sort of detail some of the priorities that we are thinking about as we move into the new year.
Absolutely, Sashi. I don't think I need to ask the question. This is something which was lined up anyway, and since you are in the momentum, why don't you give us some insights on what are your priorities for the next phase, and how are you positioned vis-a-vis that? So what's the distance that you would need to cover for that?
Right. So a lot of people on the call, including you, Prakhar, probably know the 5 key strategies that we have talked about. All of them are no more a bird in the sky. We have already implemented them. We have seen we have sort of experimented and even sort of seen the stress under stress conditions as well. So now we are quite, at the right time, I think we will be scaling that up. But the first amongst the 5 key strategies that is going to be a key priority is the digital transformation 2.0 of the bank. Over the last 5-6 years, we've had one round of disruption by trying to re-engineer processes, by stitching the front end to the back end and trying to create some wow products and services for our existing set of customers. Some of it, whether it's a 10-second unsecured loan, the 10-second auto loan, the 10-second two-wheeler loan, do your own loan against securities, the instant virtual card, the straight-through MSME loans, etc. All these, mind you, without compromising on our risk standards. All that we have done is we stitch the front end and the back end to be able to give pre-approvals to the customer so that when he gets onto the net and mobile banking, he can take a loan with a few clicks. This has given us a fair amount of scale, and by virtue of this scale, we've been able to bring down our costs. The pace at which our costs has grown over the last 10 years has been much smaller than that of the revenues. So you could have a jaws widening, which is the reason why we could bring down the cost to revenue from a 48-49% to a 38-39% on a core basis. We believe that we still have a larger room to have a glide path downwards, because there is still a fair amount of processes which can be re-engineered to make it even more straight through and less of human touch. But that's fine. But now we realize that, look, when you have to now, we also recognize that over the last 25 years, our technology strategy has been to have an open, scalable platform. What it means is that we have a core layer, and as and when we start to, bring about products, we added slots in our core layer. A slot for the branch banking, a slot for retail assets, a slot or a systems for cards, a slot for third parties, a distribution, and so on and so forth. Now, while this is fine when you're growing, I think when you're furiously growing and constantly growing at a furious pace over the last 25 years, what happens is you do have a lot of joints which happen from the core layer to the engagement layer, the customer layer. Now that is inevitable, and that's how technology normally evolves across banking systems globally. So what we have decided is to take a bold step to disrupt ourselves on that one. Whilst we'll constantly try and rationalize the applications, try and see that we can have a more clearer path from the core layer to the engagement layer so that the joints are much lesser, so that I can have a far more seamless experience for the customer when he wants to take an unassisted journey. But having said that, this will take a bit of a time, and this may be slightly, risky in terms of trying to do a lot more things on our existing stack. So the thought process is we need to disrupt ourselves by creating a parallel stack, which will be the new age, which will have a fused architecture, so that we are able to have a straight highway from the core layer to the engagement layer. It may sound, I may be oversimplifying this, but that's the game plan. And that's something that means that you have to start partnering with the latest generation of minds in the technology world. I do believe, yes, we do acknowledge that the banking technology is probably 10 years behind any other technology in the world, especially on the platform players. So we want to disrupt ourselves to move so that we are able to counter any future competition that may emanate from the platform players and other neobanks that may happen. So we are probably in the final stages of trying to ink that out. I think in the next 6 to 9 months, you should see some amounts of a peek into what we're trying to do with the first phase launch that may happen. So that's part one. Now, this is something very important from a futuristic perspective, because this will shape the way a consumer of HDFC Bank will try and sort of engage with the bank. The second one is, mind you, we're not trying to jettison the existing stack, because there will be 70 million customers there. We'll give the customers an option, whether whilst we constantly will try and improve the journeys, but I guess, the customers will have an option if he wants to move on to a much better experience. So we believe over the next 5 to 7 years, there will be a slow migration of existing customers to the new stack as well. So that's the game plan that we have. This is a necessary investment and probably strategically very important for us. The second one is that by virtue of being one of the largest banks in multiple customer segments, multiple products across both wholesale and retail, we've had a lot of dominance in various in pockets of the ecosystem of the country. So let's take example. Let's try and take the healthcare. We have probably one of the largest portfolios of doctors in our retail franchise. We have one of the largest portfolio of hospitals in our the SME and the emerging corporates group. We have a large portfolio of offline pharmacies in our retail franchise. We are one of the largest working capital bankers to the pharma companies. We are the largest working capital bankers to the diagnostic companies or the equipment diagnostic companies. We do equipment diagnostic funding to doctors and to hospitals as well, and we are a market leader there. We have a fair amount of customers on the e-pharmacies and the electronic diagnostics. So we have, and of course, I must start on the health insurance as well, where we patronize open architecture. So when you have all these pillars, each of these pillars, when you just think about it, we are by far the market leaders there. So what we are seeing, what we've realizes that we can create an ecosystem by being at the center of all this, by stitching each of the pillars digitally. So that's a journey we've commenced. We hope to, this is not an easy journey. It takes a lot of hard work. We are partnering with a lot of fintechs and which will help us integrate all the pillars. The objective being, when people, whether it's B2C or B2B, when people think about healthcare, they can go through our ecosystem. We are helping people to get onto the health, to whatever services they need, whether it is on a B2C basis, whether it's appointment with the doctors, whether it's counseling, whether it's purchasing pharmacies, medicines, whether it's fixing an appointment with a doctor, whether it's getting an appointment at the hospital, whether booking at the hospital, whether it is buying insurance, whether it is, so you name it, we will have it, and you can either make the payments on the ecosystem or you can give a loan depending on where it is. And all because you will be at the center of this entire system, you will have a huge amount of data that will be moving around, which will sort of feed into our analytics system to be able to provide decision and APIs for integrating into these various ecosystems. We're trying to launch the first sliver of that by tying up with a large healthcare company shortly around September, October. I think that is going to be the beginning of a wonderful journey. Now, by virtue of this, this thought process, we're going to extend it to all the other areas where we are market leaders. We've already started to create the ecosystem of the auto world, whether it is trying to stitch the manufacturers, the dealers, the service centers, the insurance companies, and other, all the, even you call it the likes of a Car Deco and all the used car portals that have come about, so that anyone who wants anything to do with the car, whether for exploring the car, whether it's for having a test drive, for buying a car, for getting a loan, for buying insurance, for booking a test drive, for exchanging a car, for selling a car, for booking for maintenance, for booking for servicing, all that can be done seamlessly between an offline and online mode. That is the kind of ecosystem that we're creating. And we'll be at the center here too, providing not just payments, but also the loans. So like this, we're going to create, we're launching the merchant or the trade ecosystems, which is by virtue of being the largest payment bank in the country, where almost about 40 to 50% of the transactions happen. We have a 2 million merchant acceptance points. We want to ramp it up over the next 3 to 5 years, maybe double it. As you know, the potential there is large. There are 50 million merchants, organized merchants in the country. Even if I start with an initial market share of about 10% of that, but still continue a large wallet share of the payments going through our payment gateways and our POS terminals, I think the ability to create trade ecosystems between the merchant, providing him inventory management, providing him accounting, providing the loans and the payments is something that we are launching that as well. So, or the rural ecosystem. So simultaneously, we are trying to focus on getting all the ecosystems up and running. This is each of this will take a 2-year to 2.5-year journey. But once we sort of get into that groove, we will probably create a bank within a bank. So this is very important from a medium to long-term perspective, and we are the teams are all energized to sort of partake and contribute to this wonderful journey. So this is going to be our top priority. In addition to that, of course, we realize that engagement with the customers, both on our inbound and outbound, is something that we need to have the best of technologies. So we are moving into the top quadrant in getting one of the best contact centers, riding on AI platform, the best in the world, that will be implemented on a cloud basis. Yes, cloudification of both applications and hardware technology is another one which is going to be a departure from our thought process in the past. We probably have now a roadmap how to secure ourselves in the cloud with the right parameters, the right controls in place. So that's a huge amount of learning that we've got, and we believe that that's going to really help us in stepping up our transformation in the future. So amongst all the 5 key strategies, the digital strategies, not restricting ourselves only to the retail part of it, but also to the SME, the wholesale part of it, the B2B and the B2C is going to be creating, is a very important area or initiative that we will do. I know this is not going to be, the things are not going to be easily visible now, but it will start to take a geometric way in terms of once it gets implemented in about 2 years, usage, and hopefully by then we would have, the economy and the underlying economy also sort of moving up. I think we should be in a good position to scale up as we had envisaged, or Mr. Puri had envisaged over the last couple of years. So that's part 1. Part 2, I've already explained this, is the reimagining the branch channel. We have done the phase 1 of it, which sort of led to a step up in customer acquisition over the last couple of years. From 2 million customer acquisition 2 years ago, last year we reached 6 million customer acquisition. We will be stepping up that even now. The good part is even during this COVID time, despite a lot of the entire, almost 70% of the workforce working from home, we've been able to continue with the same energy levels in terms of customer engagements, speed up the digital journeys in acquiring customers. It's quite amazing. Even I'm amazed that we could achieve an 80% of what we achieved last year, despite the COVID impact in terms of customer acquisitions. So this is going to be another important channel, whilst digital is going to be something that we want to have a separate channel of almost 25-30% of our business should come out of digital, unassisted. The assisted digital journeys from the branch channel is also going to be very important. So the phase 2 of the branch reimagining would be to ride on the collateral benefits of digital transformation, the better tools, which has been there, but even better as we move on. So that is where we have now a hungry management team there, full of energy, and without any nudge, they are all self-initiated, self-motivated to be able to bring in changes which are very progressive and without compromising on our ethos. So that's something that we're quite excited about. The third aspect of that is what we call riding on the digital 2.0 on the virtual relationship management program. All of you know that we have now almost 6 million customers managed by 3,500 virtual RNs. We realize the more you engage with customers, the more you're able to move the primary relationship into our fold. That's the key objective, because we were pretty good in acquisition, but we realized we never had the energy to engage once we acquired a customer. So these simple things which we are trying to address that at a much lesser cost structure if you had to put up physical RMs, it's going to be a very expensive proposition. You would have had to have an army of people to manage a large section of the customer base. So we've come out with a remote RMs and the virtual RMs where they too will ride on the latest digital journeys to be able to provide products and services to the 6 million customers on an assisted basis. The game plan is that we would like to have at least 25-30 million customers over the next 3 to 5 years managed of the virtual relationship management stack. The fourth part of it is on the payment side of the business, which I have explained. We are going to ramp up our the penetration on the organized merchant base, both offline and online, is still very small by the financial institutions. We have ramped up our journey over the last 3-4 years, ever since demonetization, from 17 onwards, from a 250,000 merchant acceptance points. Now we are about closer to about 2 million, 1.8 to 2 million acceptance points. As I mentioned to you, there's a potential to really double up over the next 3 years, which is what we want to do. By virtue of creating offline ecosystems and also digital ecosystem, I think we should be a market leader in that. On payments, this is something that a lot of people have asked, why are we into this business when it's the payment, especially the pricing on the payment side is pretty much warped. We are here not for, it may be a loss leader on the acquiring side of business, but when you look at it holistically, both on the issuance side, because almost 60% of the transactions that we acquire are all our own customers, what we call the honest customers. So when you complement the issuance and the acquiring, it sort of changes the profitability dynamics. That's number one. Number two, we are here because it complements the banking part of the business. When you go to a merchant, we would like to have his current accounts, his family accounts, and even if he has a decent amount of employees, we take the salary accounts as well. However small, a 20 salary account is also important for us. And of course, by virtue of the transactions, we may be even able to give him a small working capital loan or a two-wheeler loan or a small light commercial vehicle loan for his business needs. So this changes the profitability dynamics, and this is what salivates us. And that is why we are one of the few banks who believe that there's no point churning this out into a JV or selling it off. We would like to rather keep it, and this is strategically very important for us. In addition to that, by being market leader of almost 40 to 50% of the country's transactions going through us, we have a huge amount of data which is getting into our data warehouse analytics, which is what we will monetize at the right time. Last, I've talked about the digital part of the journey. As I said, the key, apart from whatever I've said, is collaborating with a lot of corporations and with platform players so that we are able to open our APIs, and so that we can integrate our APIs on their platform. All along all these 25 years, traditionally, we have had customers walking into branches. We have had customers walking into our web, but we have almost about a huge amount of footfalls on a monthly basis onto the web. But the trapping of that or the conversion of that is still small, but we believe that we can do it even more. Similarly, we have a lot of people getting onto our net and mobile. So there also we are trying to see how we can be able to fulfill some of the needs that may be there using analytics that and with better consumer journeys, we'll be able to close journeys on an unassisted basis. But the universe is large. We realize that with more and more people getting on for their day-to-day needs on various platforms or even offline areas, whether it's whether it's the likes of Amazon or a Walmart, or whether you take the offline stores of Chroma and Westside Plus, for example, or any other such large consumer durable centers, or when you take, we have a huge salaried base where large part of our salaried customers are working from their ERP systems. So we believe that we can open up our APIs and integrate them so that we attract a new source of channels for us. The footfalls are going to be very high outside of our universe. So can we collaborate and can we start to track that kind of customer base into offering our products and services? All these while, over the last 2 years, we've done a fair amount of experiments, both from a consumer journey side. We've tweaked it. We're now starting to get better success rates. We have also changed the mindset of our credit teams, who have observed it for a couple of years now to see what is the kind of, the back testing they need to do, whether it is meeting their hypothesis or not from a credit perspective. So I think, we now are on the inflection point of partnering with a lot of these platform players and corporations. So that's going to be a key medium to long-term strategy, where you will suddenly see a new channel emanating what we call the edge banking. So that's something that we are quite excited about. At least over the next 5 years for sure, this new channel should contribute to almost 25% of our business as well. Last but not least, we have spoken a lot about semi-urban and rural. That's where India lives. And that's where you are starting to see the per capita grow up. That's the inflection point for demand for financial services. We don't want all the geography. As I said, we have enough, and we will have enough just by focusing on the top segment of that rural geography. That's why we are investing a lot in this geography by putting in partnerships and expanding our distribution. We're not going to dilute our credit standards. The same customer segmentation is what we are looking at. And since we are one of the few banks to have had an experience over the last 10 years on the asset side of the balance sheet, we believe we have probably the right time when the economy opens up, the right time to press the pedal in terms of accelerating the distribution of products from that geography. So these are some of the ones which we are going to focus on. These are not new. All I need to do is carry the energy of the team. We have a wonderful team. That's another, the greatness of Mr. Puri in terms of, thinking ahead to ensure institutionalize the people and process such that we are not dependent on any one particular person. It's going to be a collective journey. I'm going to be just first among equals. I think we have a great opportunity. It all depends on how I execute it. This is, as I mentioned somewhere else, that he is given to me on a platter, and I hope I don't squander that. So let me pause out here and take any further questions.
Sashi, thank you, and it was very modest of you to end on that note. But if I could just stitch things together, do you think it's fair to say that in the next phase of your journey, the focus is seemingly shifting towards revenue market share rather than purely a loan market share? You're creating ecosystems around your own domain strengths, etc., so that you can optimize on revenues. Is that a fair way to look at things?
No. See, the point is revenue is going to be an end, byproduct. The fact of the matter is we need to follow the money concept. Just think through, keep it simple. We want to ensure that in every aspect of our business, We want to follow the money and try and see whether we can keep the money within our ecosystem. That's the fundamental principle that we are working with. The fact that we have gained market leadership in various segments that we are in, and the fact that we have worked into each of these chains of the ecosystem, we have now an opportunity to stitch them together. So, the moment you trap the monies within the system, it's a virtuous cycle, and you'll be able to sort of, get a fair share of the pie, including the data, and by having, technology in between that, you'll be able to provide a great customer experience for the customers to be able to get what he wants. And my credit team will also be extremely happy because, once you start to ride on the public APIs or the India stack or the account aggregator stack or the OCEN network rails, and there'll be multiple such, open architectures that may come about. There are two ways of looking at it. Either you look at it as the glass half full or glass half empty. We believe we have to look at it glass half full. We are surely vulnerable because we have a large customer base. We are market leaders. People would like to nibble away share from us. But if you look at it positively, we probably can even gain more share, even though we have a large balance sheet. So, the ecosystems are a way of trapping the money flows and creating a virtuous cycle to be able to be in every aspect of it and provide products and services on the fly without any manual intervention. So that's the key. And so, it will sort of drive your top line, it will drive your revenues, etc. Even in future, with all this so-called commoditization of products and services, which is bound to happen, you'll be too naive to believe that it's not going to happen. You'll be too naive to believe that the margins is not going to come in. But you need to ensure that whatever you're trying to do, your incremental cost of the margin should be near zero. It won't be zero, but near zero, just the technology cost and not the manual intervention cost. Only then you will have enough buffer to be able to continue to maintain respectable ROAs.
Got it. That's very nice of you. I would probably open the floor for some questions. Operator, would you take in the ones that have come in?
Thank you. The next question is from the line of Siva Natarajan from GW&K Investment Management. Please go ahead.
Yeah, hi, thank you, and congratulations, Shashi, and wish you all the best. I have three questions. First one is related to the current asset quality cycle. If I look at your specific provisions, general, contingent, all put together, it's about 1.5%, 1.6% of loans. But if I look at NPLs plus loans in moratorium, it's about 10.6% of loans. What is the thought process behind providing so far only about 15% for the NPLs and moratoriums combined? Why not more? Or are you seeing something in the loans that are currently in moratorium that you feel will eventually perform? That's my first question.
Okay. Should I wait for the other questions, or should I answer the first?
You can go ahead. The others are not related. So.
All right. Thanks, Shiva. Thank you. Yes. We have had the habit of sort of providing countercyclical provisions when things are growing well. And even in the last quarters post the pandemic, I think we have created reasonable amount of COVID provisions or the credit buffers on account of the COVID. So obviously, this is not just an ad hoc number, but a well-thought number as to, stress testing our portfolio to see what is it that could potentially slip in and whether we have, what is it that we need to create a provision to be able to counter that. Now, you're right, 9% of our book as we exited June as we entered the moratorium 2, that point in time, 9% of our book was in moratorium 2. But the reality is, the 9% in moratorium is not necessarily will translate into slippages. When you look at that 9%, the quality or the profile of the 9%, you'll be amazed to see the characteristics there. 97% of the 9% who have opted for moratorium 2 are customers who have never defaulted before. They were 0 days past due for a long time before COVID. That's number one. There is an element of salaried customers as well in that, and 98% of them actually have got salary credits. The third characteristic of that 9% is that there have been a 50 to 55% or 56%, if I remember the data right, of people who took moratorium, the second moratorium, despite paying the June installments. So when you look at this and piece it together, the quality of what we believe now is that we should not see too many issues in terms of them having a bit of a problem in repaying as we move ahead when the moratorium exits or when a moratorium gets over. So we believe that most of them have taken for contingency measures to be probably just to be provide or have a liquidity support, and not necessarily to suggest that they are having a problem. It doesn't mean that all the 9% that we're talking about is going to be good. Yeah, you will have some amount of slippages arising out of that, but not the entire 9%. Basis whatever we do, we see from the 9%, which is obviously a bit of a question mark, but we have to keep on looking at it. We saw the June profile, we saw the July profile, how they're behaving. Obviously, we need to attempt when we exit 31st August, we need to try and see what happens when we present the checks for such customers. That will be the acid test. But largely, from whatever we have seen thus far, we believe that a fair amount of collection should happen on an auto basis. But there will be a bit of a slippage emanating out of that. Probably just to recap what we did in the first quarter, we have been doing a lot of analytics, and wherever we believe that even though some of the customers did not become an NPA, we are probably one of the few banks which sort of prepone some of the recognition as NPAs. We have, and the impact is all as high as about 30 basis points. So we will constantly do that if there is a need for that. We strongly believe that we should be able to contain the slippages over the next couple of quarters. Somewhere, in the range of 1.5 to 2% is what it'll settle down. I don't know where exactly. As I said, there is a bit of an unknown in terms of how the collections happen post August 31st. So far, we're comfortable, but yes, we need to sort of take some amount of probability on that particular aspect as well. So this is our broad field basis analytics and basis what we see on an ongoing basis in terms of their behavior, because a large part of them continue to have accounts with us or get salary credit. So basis that, that's our hypothesis. So this is where we've come to. We are not seeing too much of an issue out of that. So when you believe that you can contain the gross NPLs at about in that range, we believe that the provisions are reasonably adequate to cover up that particular range of gross NPLs.
Thank you. Thanks for the color. That's helpful. My second question is the recent news about Rosen law firm potentially, I guess, seeking clients for a class action lawsuit. What are you hearing in terms of what the basis of the lawsuit is? I know there's no lawsuit yet, but what is even the basis that they are trying to recruit class action?
Srini, you want to take that?
Yes,
on top of it.
Okay. Yeah, Shiva, exactly as you mentioned, this is trying to see if there is any interest on any of the quarters. That's where it is right now, right? What can be the basis is not determined by anybody, nor do we know. As much as you are reading, we are reading. So there is no cause for action at our end, or there is no notice, or there is no actionable at our end or anything. As much as you figured out, we also figured out from the press. We figured out from looking around. That's all we are. In terms of where one could take, it is anybody's imagination at this stage, right? So there is nothing that we have seen that is giving any substantive things to look at.
Okay, thank you. And my last question is related to Mr. Puri's sale of almost his entire ownership, stock ownership in the company. It just seems a little awkward, if you will, just the entire ownership that he has had, he's selling. Any indication of why?
Yeah. Sure. This is not something that's come as a surprise because he has been discussing with some of us. I've been one of his advisors as well. I have been, the fact of the matter is, he's turning 70, and he obviously, some of us don't take care of our personal finances the way it should be done. Can you hear me? Am I audible?
Yes. Yeah.
So we realize that he has a preponderance of exposure on one stock, and when you're turning 70, you need to plan for the family, and that is something that is very imperative. That's part one. Part two, as you know, there are a lot of options that were granted about 2-3 years ago, which will start to vest on retirement. On retirement, all the unvested options not necessarily vest in future, but vest at on the day of the retirement. So he needs a lot of liquidity to be able to sort of exercise those options, which is almost 60-70% of what he has sold. So he will get into the equity stock back on in October when that exercise happens. That's part two. Part three is that, the timing of that. I mean, we had planned some time ago, sometime around February and March, little did we expected the impact of COVID and the aftermath on the markets. So we had paused it, and we had said that, look, we don't have enough time. We surely need liquidity for the October exercise. So the first instance that you see some amount of spring back in the markets or in the stock, let's sell off so that you have enough liquidity to be able to sort of acquire the balance options that will vest in October. So that is a thought process why he did that. So I think it's fairly justified at some point in time for a person who has, let's face it, I mean, so selfless is a man that even today, and Srini can bear me out on this, we are on our toes. He keeps us on our toes, not for the near term, where the fruits of all that he's pushing us is going to come in the next 2 to 3 years. So I think it would be not appropriate for anyone to cast aspersions on why he sold or feel anything awkward about that. I think there is a fair amount of reasonable justification why he had to do that.
And also keep in mind, whatever is there has to be close to 40% or a little more tax paid on what is liquidated.
and the tax then 40-odd% has to be paid on the exercise on the day that he exercises in October. So taxes are 40-odd% to pay on all of these things. So keep that also in the context.
Yeah, that's right. That's right.
No, thank you. That's very helpful. Also to know that, the option exercise will get him back 60 to 70% of what he's selling. Yeah.
That's right.
Yeah. No, thank you. Thank you very much. That's it from me.
So thank you, Shiva.
Good luck. Yeah.
Thank you. We'll move on to the next question. That is from the line of Piyush Mittal from Matthews Asia. Please go ahead.
Hi guys, thanks a lot. First of all, Shashi, best of luck for your tenure as a CEO going forward. And also thanks a lot for providing a lot of detailed color on the previous participant's question. That was very helpful. I had a couple of questions. One was
Hello?
Sorry, Piyush, we lost you. Hello?
Piyush Mittal, we are not able to hear you. Hello, Mr. Piyush Mittal. Ladies and gentlemen, we seem to have lost the audio from the line of Mr. Piyush Mittal. We'll move on to the next question. That is from the line of Gurpreet Arora from Aviva Life India. Please go ahead.
Yeah, thank you for this opportunity and congratulations to you, Shashi. I just have one question, and that is with respect to the concentration of advances. If I look at our top 20 exposures in last 2 years, they have grown to the tune of 35 to 45%. So if you can share some thoughts on these.
Good. Thanks, Gurpreet. The top 20, 25 exposures that have grown over the last probably year or two. Can you hear me? Am I audible?
Yes, very much.
Yeah, sorry. Is primarily on account of the fact that we have a lot of strategically important government-owned Navratna companies which have been patronizing us over the last 2 years, because they realize that these are some of the gems which are where they have a fair amount of guarantee, which probably would have gone to some of the public sector banks in the past, but they realize that they need to have a constant tap of a bank which can provide incremental funding on a very consistent basis, a bank which has adequate capital, less of asset quality issues, and a very robust funding, granular funding, because these are very important indicators to say that, yes, we will not be, downsizing growth, etc. So, and a combination of the hungry distribution platform, both in the corporate and the retail side, we have been, stepping up our marketing efforts, and I think the corporate banking team has done a wonderful job in trying to nibble away some of the incremental share from the PSU banks in these high quality, low risk corporate assets. As probably Srini and Jimmy may have mentioned in the last earnings call, the incremental assets that have been put up over the last year or more, and largely from the top 20 exposures, are at such a low risk that the rating is much better than the stock rating. So they are all AAA rated, largely government guaranteed. So in terms of the probability of defaults is very low. I think that's what we have done, and this is a kind of an opportunity which is thanks to the platform, thanks to the kind of hunger that the team has depicted, and the fact that we had a great balance sheet. Long time in our portfolio.
Sure. My last question is on our subsidiary HDB. At what level of priority is that for you? Last two quarters especially has been pretty off our usual track record. So if you can spend a couple of minutes on what's happening there and what time will this take of yours? Thank you.
Right. So HDB is continues to be very strategically important. It's when I say strategically important means not for us. It occupies a very key customer segment in the India's ecosystem. They sort of cater to about 2 to 3 notches below that of the bank. So there is a top 20-25% of the customer segment which is vacated by the likes of a City Financial and GE Financial once upon a time, and there was a segment which is something which we were, which is pretty good, not the subprime kind of guys. So this is a company which is well run, but being in that kind of a segment, obviously they will sort of track. They will have a slightly higher expected loss, and will track a higher losses during the down cycles, and it is exactly what they're trying to do, or which has happened over the last couple of quarters. I think despite whatever we are seeing even during the pandemic, I think their track record in terms of how they are navigating the COVID period, collection efficiencies and the resolutions as we are seeing, continues to be pretty encouraging. They continue to maintain reasonable amount of stability in their balance sheet and the revenues. It may be a bit of a degrowth because of the higher provisions that will carry because of Ind AS. The Ind AS Stage 2 and Stage 1, not necessarily on account of actual losses, but you will have to overlay the economic expectations on the expected loss model as well. So you will have to sort of take higher provisions, and you do see that in some of the companies, NBFCs, which are there. Of course, there are some other NBFCs which are even better run, which is what Srini and I have a look at it. But largely, I think we are extremely happy with the way they are managing this particular extreme situation, unprecedented situation. I think, yes, from April of next year, I think you should start to see the kind of growth that one would expect from that particular franchise. We own about 95%. As I said, as of now, he doesn't need capital. He's reasonably capitalized. If at all there's a need, we can also infuse capital in him. But we have applied to RBI for permission for him to sort of think of other options as well, outside options. That permission is waiting for the RBI nod. It's quite some time since they gave us a nod. Probably there have been a lot of events in the last 6-7 months which has distracted them from coming out with the paper on bank-owned NBFCs and what is the kind of ownership that needs to be there. So let's wait and watch what the RBI directions come about. But I think it continues to be a gem, and it will surprise a lot of us in the next couple of years.
Sure. Thank you so much, and all the best.
Thank you, Gurpreet.
Thank you. The next question is from the line of Josh Badia from Baron Capital. Please go ahead.
Thank you very much for the opportunity. Congratulations, Shashi, on the new role. We wish you all the best. I have 2 questions. One is with regard to the bank's risk appetite. In the last quarter, we saw a very clear divergence in terms of asset growth between you and your main peers. And I just wanted to understand what you're seeing differently than they're seeing, and sort of in terms of the level of risk and the appetite to grow. And if you think that we can expect to see a similar growth trend in the next couple of quarters as we close out the year. And the second question is more broad with regards to your fintech or digital ambitions. Obviously, you've identified this as a key priority. So we wanted to understand, where are the areas where you see potentially the biggest threat from larger players or tech players or new incumbents that you need to protect? And where do you think HDFC Bank really has some vulnerabilities or areas that they need to reinforce, and sort of what kind of expenditures will be incurred to bolster those?
Yeah, thank you, George. See, the kind of growth that we have seen in the recent past, as I mentioned in the call earlier, is primarily arising out of our, the fact that we are patronizing a lot more corporate, and that to low-risk government-owned strategic assets, companies, as they call it in India. So these are probably opportunities that may not be there as we go forward. So all that we have done is because of our platform, our distribution, and our marketing initiatives, we have been able to be ahead of the curve in trying to prepone some of the opportunities that are there in that particular space. So this is something very similar. This is not something out of the box. We did the same thing in the aftermath of the global financial crisis. So that's the beauty about our platform, that we normally have multiple levers, and during times of adversity, we are able to sort of pull up some lever when the other lever sort of, is a bit tepid. So this is exactly what happened even at that point in time. We sort of saw reasonable amount of healthy growth in good AAA corporate assets at that point in time. Here too, that is what has happened. But I'm not too sure, and we are not sort of banking on similar kinds of growth rate from the corporate side as we move into the future quarters. You will see sequentially that sort of paring down because a large part of it would be still working capital, and people probably had sort of taken liquidity buffers, providing liquidity support to them, just as contingency measures, and some could be refinance of some on the term side. So whether that opportunity will continue to play, whether it is something we are not banking on. But what we are banking on is that hopefully as we enter into October, which we are already seeing, the retail should start to bounce back. As we speak, we are more or less, depending on the product, anywhere between about 70 to 80% of the pre-COVID levels. But hopefully by September, we should have touched the pre-COVID levels in terms of incremental disbursals on the retail side. And probably in the third quarter of this year, all things remaining same, we should have the retail probably grow higher than what they did over the same period last year. So we should see the retail compensating for growth from third quarter onwards. So that's where, and then you will probably see a balanced growth between retail and wholesale as we enter into the next fiscal. So that's the game plan. I mean, we normally don't give a guidance of where we do. As I said, we don't have a number for growth, but we will not miss out on opportunities. But we believe that, the kind of growth that we have seen on the corporate will not be there. So we are hoping that retail will compensate for that going forward. That is your first question. Second question was on the, sorry, what is the second question, Srini?
Digital.
Oh, yes.
Yes.
On the, let's face it. I mean, as I mentioned earlier, I think if we don't focus on transforming ourselves on the digital 2.0, the threat will come in from the platform players. The money muscle that likes of Amazon or Walmart or Jio is going to have, the fact that they will be commoditizing in the financing part of it, unless and until you don't have a head-to-head similar kind of a platform from a customer experience and a journey perspective, you will be moribund. So it's better to sort of, put in all your energies and efforts to come up to that level and then take them on. But having said that, we are not planning to take on anybody. We are, on the contrary, happy to even collaborate. So the likes of, we are in partnership, we are in talks with the likes of Google, the likes of Amazon, even as last week, I think they had their first, Amazon had the first sale post-COVID. And we contributed to a very significant portion of their traffic. So they realized the kind of value addition and the kind of traffic that we provide to these platforms. So people are happy to collaborate, and that's exactly what our focus is going to be. We don't want to consider them as a threat, even though they may, provide similar kind of products for us, but we want to ride on their customer footfalls. We would like to sort of ensure that they can consume our products as much as the partnership lasts. And if for whatever reason it does not, I think by then we would have had our own platforms on par with theirs, which we probably could have stepped up the acquisitions and also our penetration into our customer base.
Okay, thank you.
Thank you. We'll move on to the next question. That is from the line of Moon Sarana from Harding Loevner. Please go ahead.
Hi, Shashi. Thank you for your time and congratulations. You talked about the payment business and how merchant acquiring is not that profitable of a business for you. If you think about the innovation that has happened in this segment around the world, like players like Adyen, Stripe, Square, it seems like the incumbents around the world have been struggling, like the banks, when it comes to coming up with like a e-commerce kind of a solution. So I would like your thought on that, and how is HDFC Bank preparing for a scenario like that in India? Thank you.
Thank you so much. No, you're right. I mean, that's another area of partnership. I mean, we are also partnering with the likes of whatever you mentioned, including an M-Swipe or a Pine Labs, etc. We are in talks with all of them. As I said, we are open to collaborations and partnerships with a lot of these players. We realize that it's a synergy, and that you have to have a symbiotic relationship. And this is something that we have been nurturing for some time. It may not be visible now, but I guess as we move into the next phase of growth, which is what we had all implemented, these kind of partnerships with the likes of what you mentioned in terms of the names that you mentioned are all that we would like to partner. Some of them, of course, we have not even reached out. There are a lot of others similar to the people who are already in India. We are touching base with that. The issue is not about adopting technologies or adopting any partnerships. The issue in India is all about for some historical reason, the merchant discount, and you can compare with anywhere in the world. The merchant discount rate globally, barring Brazil, which is at a very obnoxious 10 to 15%, in rest of the world is somewhere around 2 to 3%. In India, it hovers around 1 to 1.5%. It's slowly inching upwards. It used to be 1 about 3-4 years ago, but we are seeing a bit of a consolidation where the average MDRs have moved up somewhere around the 1.3, 1.5%, which is not bad. So what happens is at that 1 to 1.5%, depending on what kind of cards people use, the interchange that one has to pay to the issuers ranges. It may be probably, with the interventions of the government and the regulator over the last 3 years, the debit card, has a marginal profit in a few basis points, which is fine. So even if you're having a large volume, it's not a drag. But on the credit card, it is a drag because especially when you're dealing with the best segments and the best type of cards, the interchange is something more than what you earn as an MDR. So even if you were to link up with the likes of Stripes or any one of the similar kind of partners that you've just spoken about, the issue is not about partnerships. We are happy to do so. The issue is that the pricing, for whatever reason, is tending to a virtually zero level. So, frankly, we are all right with that. As I mentioned to you, there's not too much of a disruption that one would have on the profitability because our profitability is not coming out of the payment side.
This conference is scheduled to be disconnected automatically in 9 minutes.
Right. Can I continue?
Yes, sir. Please go ahead.
Yeah. So it's going to be, it's emanating out of the banking business that I get out of these merchants, these partners, what I can provide, what I can get as current accounts and savings accounts, and what I can provide loans to the merchants, etc., or to the family members. So partnership is not a problem. We are happy to partner, but the fact of the matter is that a certain amount of DNA which is there in the Indian markets, which is very difficult to dislodge. So the only way that one can improve profitability is how you nurture and you cross-sell and you get the banking business out of these ecosystems.
Okay, thank you very much. I also wanted some more clarity on the two stacks that you talked about. You will have the banking stack, and then you are talking about creating a new stack. How would that be different? Could you provide some more color on that? And
so that affect your expenses? Yeah, sure. The existing stack is something that we already have. We need to, try and see how we can, rationalize some of the applications, rationalize the capacities, or have in-sync capacities so that we're able to absorb volumes, migrate more to the cloud in terms of applications and hardware now that we have a better understanding of that, so that we are able to scale up, which is what we need to be well prepared. So that's part one, with our existing architecture. The new architecture is something which is going to be very nimble, agile, which is going to be fused, so you don't have too many hops, too many joints, so your journeys are going to be even more frictionless and seamless. Somewhat, I don't want to mention the word, but it's very closer to creating a neobank within a bank. So that's the thought process. It's, we will unveil it probably over the next 6 to 9 months' time. The journey would just about to begin. And I'll give you more color about that. But that is important in our long-term strategy.
Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Prakhar Sharma for his closing comments.
Thank you. And, really, Sashi, Srini, and Ajit, I'm really very thankful for sparing this time out, especially at odd hours. We're just nearing midnight. So it's really nice of you and generous of you to do it a little longer than what we had asked for. So I'm really thankful for you to do this. And to all the investors on the other side, thank you for being there on the call, and I hope you found it useful. Have a good day ahead or good evening ahead. Thank you so much.
Thank you. Thank you all who are being on the call. Thank you very much.
Thank you, members of the management team. Ladies and gentlemen, on behalf of Jefferies India Private Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines. Thank you.